So let's talk about the follow through days kind of in the context of where we're at. Justin, if you could show with your cursor.
So I'm just going to show the slide real quick. Can you see the slide that he put out there? So, okay. So we'll go back to the, I'm trying to get fancy like Allie, and I'm just not there yet, but go ahead. Where would you like to go, Eric?
If we go to the NASDAQ, and if you draw a red line at the bottom of the low of the follow through day that we just had on January, was it 31st, was it?
Yep, right here. So here's our low.
Yes. Okay, that's a key line. And this harkens back to the slide that you just showed. I've studied follow through days all the way back to 1949 now. And I have over about 300 of them. And I get very meticulous about looking at when the rally starts, what the close of the first day, the index was, what the end of the rally, what the value of the index was, what percent they go up, how long they last, and those kind of things. It's interesting to go through some of the statistics. And one of the things I noticed many years ago when I first started studying this was if you close below the low of the follow through day, that is like going to be like almost a sure sign the rally is going to fail. I have found that if you close below the low of the follow through day, 97% of those rallies end up being what I would consider not successful. And you have to define what success is.
Yeah, that's a big issue.
And that's a big thing. And for me, a rally that is less than 15 days from the start to the finish is a whipsaw, and that is not successful. And then you get a category of rallies that are greater than 15 days, but maybe by the end of the rally, the index has only gained 3% or less from the close of the follow through day. And I call those slogs or small losses and gains. And those turn out to be about 40% of all rally attempts. So there's a lot of them. Whipsaws end up being, off the top of my head, I can't remember. I have to look at my little chart. But whipsaws end up being about 26%. So you end up with 26% of rallies end up being whipsaws, 42% are slogs. So that ends up being almost 70%, right?
And what is your definition of a whipsaw?
A whipsaw is something from the beginning, from a follow through day to the rally is over, less than 15 days.
Okay. Mm-hmm.
These slogs are
the greater than 15 days, and
they're greater than 15 days, and you gain 3% or less.
Mm-hmm.
And I remember talking with Chris about this many years ago at one of the level 4s, and he said that's a pretty consistent with what Bill's had for a definition of something that would be give you enough time to get out.
Mm-hmm. Right.
So you may not make much money, you may only lose a little bit, but it gives you enough time to get out. And the rest of them they're only about 31% end up being really money-making opportunities. I categorize 25% as money makers. Those are ones that last more than 15 days, and you gain anywhere from greater than 3% to less than 15%. And anything that lasts more than 15 days and gives you more than 15% gain in the index, well, that's a life changer. Now, I'm talking about the index with these numbers, so they'll seem kind of low for gains, but you remember leading stocks can go much higher than that. And as it turns out, right now where we're at, we have not undercut and closed below the follow through day low, so we're still alive. It feels like we're hanging by a thread after yesterday, doesn't it?
Yeah.
We're below the low. I'm sorry, we're below the close of the follow through day.
Mm-hmm.
When I looked at it last night, we were already 2.5% below the low of the follow through day. So we're looking like either a potential slog or whipsaw at this point. We are kind of hanging on today. I see the NASDAQ's up about 100 points. So we're hanging in there. The rally's not dead yet. We don't have a lot of stocks to buy. So the rally's intact. It's just not looking so good.
Mm-hmm.
What I found with my study, a couple other things were these. One, the gain on the follow through day itself does not correlate well with success. And I think you guys would, Chris has published stuff in some of the level 4s and level 3s where the best days up in the market were always during bear markets, like the top 10 gains or top 20 have always been during bears. So the gain on the follow through day kind of goes with that. It doesn't correlate well with whether the rally will be successful. And the other thing I found surprising was the percent volume increase on the follow through day does also not correlate well. So you might say, oh, well, we're up 30% over yesterday, so that must mean it's a better follow through day. And the answer is no. Sometimes the best follow through days have only a small increase in volume. But so the question is, well, what does correlate well with a follow through that's going to succeed and produce a good rally? And there are two things that stood out. One was in the next few weeks, do you have additional follow through days?
Yeah.
I think you guys found this in market school too.
Right. The subsequent follow through day.
If you can have add-on follow through days or subsequent follow through days in the first 20 days, the rallies that have those end up being more successful than the ones that don't. I found in my research that in the first 20 days, if you can get the ones that make money are the ones that typically get 3 or more professional accumulation days. So that was a big deal. And when I say 25 days, I think I said 20, but I mean 25. I mean 25 trading days.
Right.
So looking at 5 weeks. If you can get 3 or more additional follow-through days, that's a good sign of potential success. And the other thing is professional accumulation days. Typically, the rallies that make money end up with like 6 professional accumulation days in the first 20 trading days. So you're looking at, no surprise, the follow-through days that end up being the most successful are the ones that show they're working.
So I'm sorry, have you done anything on distribution days soon after the follow-through day? That was something I was looking at, and then once Bill, talking with Bill and trying to define what a failed or successful follow-through day or follow-through was, and it was just like, this is too mushy, and I kind of dropped it. But have you done work on that?
I did. You get some great research that I saw you present one time, or maybe even twice in some of the seminars, and you showed that if you had a distribution day within the first 2 days after a follow-through day, you said it was like a 95% chance of failure in day 1, and maybe it's slightly lower than on day 2. My research has shown almost the same. I even looked at day 3. If you get a distribution day in day 1 or day 2, you have an 80% chance this will not be a successful rally. And if you even have it on day 3, it's the same number. So if you get a distribution day in the first 3 days after a follow through, you have a 80% chance it will not be a successful rally. It'll be a whipsaw or a slog. And guess what we look at right now, right? We have not had a distribution day yet.
Right.
As bad as yesterday was, we did not get one. So we didn't close below the low. We don't have distribution yet. So those are 2 good but slightly weak signs, because we don't have any accumulation days yet.
Yeah.
Right.
And we don't have any additional follow-through days. So if people are out there wondering, like, well, when would be a good time to invest and when should I start adding? And to me, the answer would be this. We have to start seeing either an additional follow-through day or some accumulation, professional accumulation.
One other thing on the distribution day,
stock setting up, and
stock setting up would be nice. Some setups, some bases, one other thing on the distribution day study, I remember when Chris came out with that, and he shared with me kind of the data, and I was looking at my stuff too. One of the problems was that I was a little nervous about is some of the examples of those distribution days. I guess maybe say the 10%. I can't remember which one it was, but there was a very, very powerful rally. So it was like, you didn't want to miss this one. It had a distribution day, right after the follow through day, but it was such a powerful rally, you didn't want to miss it. And so I was like, okay, this makes me nervous that if people are like, oh, that this rule would have kicked me out of this really powerful rally. So maybe talk a little bit about how you use these statistics, Eric. You've kind of got a sense of the failure rate, the success rate, but when it comes down to it, does that force your hand, or does it just basically give you context?
It gives me context, and it helps me make decisions. For example, I'm sure in that one case where that rally where you would have missed and was powerful, the context would be, I bet if you looked at leading stocks, you would have seen a lot of setups. And that's one of the things right now is, watching follow through days and watching the statistics, it's only half the story.
Right.
The other half is the leading stocks. And we do not have a lot of setups right now. I love rallies where you're looking at like, well, gee, I don't know which one to buy. There's so many.
Right.
It's like going into Costco. Oh, there's so much good stuff on sale. That's not the way it is right now. Now it's like you're walking in, there's bare shelves. But to answer your question about how does it help me, I also know like the average length of a rally. And so when I start to see us getting along in the tooth, that starts making me hedge. And it makes me less aggressive.
I think you have a paper over your microphone, Eric. You got a little fuzzy.
Oh, thank you.
There you go.
But so when you're looking at rallies, they typically last, believe it or not, like 50 trading days on average or less. That's the how long a rally will last, 50 trading days. So we start getting into, 8-9 weeks into it, I start looking at my stocks and I might start hedging mine individually, especially if they're extended. And I'm also looking at these statistics help me decide when I might start looking for a rally to turn around. Like when we get in a correction, half the rallies occur within 15 trading days of a correction starting. So like when the market goes into a correction, you really have 15 trading days on average before the next one starts. So you can't really, go sit in the hammock.
Disengage.
Right. And it's surprising. And in this case, I think you guys called the market in a correction on, let's see, it was the 18th. 9 trading days later, we got a follow through day. I'm going to take you guys to task a little bit. I think the correction started early. I think it started on January 5th. And I use another system of my own, plus another one from a friend. And I think what slowed calling the correction in this case down was we had that crazy week between Christmas and New Year's, the lowest volume week of the year. It's always the lowest volume week of the year. We had down days, but it didn't show up as distribution because volume was low. Yeah. But really, that was a setup for saying the rally was almost over. I think January 5th, the rally ended this time. You guys call it on the 18th. It really doesn't matter. We didn't get a follow through day until the 31st. But all it means is this rally, whether you said it ended on the 5th or the 18th, we still got the next rally within like 15 to 20 trading days. And that's typical. So,
but as you said before, that doesn't necessarily mean it's a successful one. It could be a slog. It could be a whipsaw. It could be one of these, type things.
And there might be no merchandise set up right. So, but you just have to be kind of on alert. It's like, okay, we've been in this for like 3 weeks. I can't be asleep. I better be looking at stocks. I better be looking at industry groups. So if we pull up MasterCard, there was something interesting about MasterCard I saw. And going to one of the model stock summits years ago, I remember Bill talking about, I think it was the 2009 rally. He showed chart after chart of stocks that made higher lows right before the follow through day. And MasterCard looks like this to me. You see the low that we got in late November. That was right there. Okay, it starts to rally, it goes up, and then the market corrects, and look at that, a higher low. Then you look at the other payment systems like Visa, it looks the same. Pull up Square and PayPal, they look horrible. So, you're looking at,
here we are, a higher low here.
Higher low. The market made a lower low.
For Block, not so much. It's even hard to kind of come up with a low. You see that this is the only marked low here on MarketSmith because it just kept on going lower and lower. And then you mentioned PayPal. So lower.
So for me, it's like, okay, I'm not in MasterCard now. I'm watching it. And it has the characteristics of, well, how about that? During a correction, it's made a higher low. And it looks like it's getting ready to break out.
Yeah. And that's a really good point, Eric. And one I think that bears repeating, just going back to that 2009 rally. So here's where it started, back here in March. We kind of came down. Actually, you know what? I'll go back a little bit more now that I think about it. Let's go to December here, just to show a little bit more. But yeah, to your point, you had this January low, and then the market really took another leg down. But exactly what you were saying, and this was a very, very big lesson for me. Apple at that time, here was that low that the market did. Apple, much better. Booking, similar situation. Baidu, I remember, was one that he was talking about. Here was the low on the market. Here's Baidu. And what you were seeing in all of these cases was the relative strength line, much, much stronger for these. And so also, to your point, Eric, you'll notice that a lot of these stocks were below their 200-day moving average lines. This was probably one of the only times I ever saw Bill buying stocks underneath the 200-day moving average line. He wasn't waiting for these, to get to get back to their highs. I mean, these were still, a lot of these were well off their highs, when he was buying these in March. But again, that signal that you just mentioned was a big one, that they made those higher lows when the market was going and undercutting its lows. So
yeah, and that was after a long drawn out bear, which we haven't had yet. So maybe we get the long drawn out bear and then we see something like that again, but we'll see. I mean, it's a very volatile time, and none of us know where it's going, right? In some ways, we kind of would like to have a long drawn out bear that we're not in.
Outperformance, right?
Right. And then have good setups, right?
Mm-hmm. So Eric, let me ask you one other question to kind of, again, put the context of these follow through days. Was there anything about maybe how far down you came, how bad the correction was? Because sometimes you find the biggest bounces, the biggest gains come from some of the worst declines, right? It's a little bit of that Newton's laws of physics type thing. So did you take a look at that at all in your studies?
I did not so much measure from the last, let's say, peak to like the beginning of a rally that works, because you end up getting many times rallies that start and then fail and then start and fail. So I didn't do that as much as I did look at where the rallies follow through day finished in comparison to the 200-day moving average and the 50-day moving average.
Oh, okay.
And so like in this case, we have a follow through day where we are below both the 200-day and below the 50-day moving average at the close of the follow through day. Mm-hmm. And those typically end up being either rallies where you can make a lot of money or a whipsaw, unfortunately.
Right.
It's not the middle ground. So
it's the extremes.
It's the extremes. So we have to be a little careful here. But no, I haven't really studied from, like, let's say that high of 16,212 down to, let's say, 13,094 and say, like, okay, what percent was that and how does that correlate to the future? But
that's very instructive what you just shared. Where is it in relation to the 250-day? That does add that element of context, because sometimes we even have and when we were doing market school, we had these situations where we were like, when do you even need a follow through day? How much down are you? How much of a correction is there before you start saying, I need a follow through day in order to tell me that we've had a change? I mean, you have to change from something, right? You have to change from a downtrend, so that was something that was a little bit of a challenge for us. We came up with a break below the 21-day moving average line, but there were a lot of cases where, that wasn't much of a correction. If you were going flat, then your break of the 21-day line was not, that was a pretty easy mark. We didn't want to miss anything, but yeah, that added context of the 50 and 200-day is very useful. Okay, where would you gentlemen like to go next?
Well, actually, there's a couple questions. People wanting a definition. So you said professional accumulation day. Is that just an accumulation day, or is there something else behind that?
Oh, I guess I use that term, but to me it just means like you have you go up and have your volume than the prior day. So that, to me, that's accumulation day.
Okay.
Is there a certain percentage you have to go up?
No, I was just talking about if you, I want you to go
A
up
blue
instead
day,
of-
heavier volume.
Right, but typically more than 0.1%. Otherwise,
Okay.
it's like stalling.
Right.
Right. And then the other question, if you could just define a slog again, what were the parameters of a slog?
That stands for small losses or gains, or a slog.
Okay.
Those were rallies.
Great.
Those are rallies that ended up being more than 15 days, but from the close of the follow-through day to the end of the rally, when it goes back into a correction, the gain of the index is 3% or less.
Okay.
And, you know, someone was asking about examples of maybe some of these rallies with subsequent follow-through days. So again, just to define that, you said the professional accumulation, that's just being up and having volume that's heavier than the day before. But a subsequent follow-through day, that's where you basically have all of the elements of a follow-through day in terms of your percent gain, volume is heavier than the day before, but it just happens in that first 25 days of trading. And it's after a follow-through day that you already had.
Exactly. And it's similar to what you use in market school. You guys had a definition, I think 1.25% for a gain to qualify as a follow-through day. So if you had another one of those days within the first 25 trading days where it gained 1.25% or more and heavier volume than the prior day, that would be another like subsequent follow-through day.
Yeah, and we do have it where it can change a little bit. Yeah, so it based on the volatility, you know, because again, historically 1% is usually enough. But there have been these periods of time, like in the late 90s, you know, and yeah, there have been periods of time where we have to up that threshold. We upped it to 1.25, but it's also that, you know, arguably there's sometimes where maybe you need more. I mean, the volatility was so much recently. We were wondering if, I mean, 1.25 would have seemed pretty paltry if we had gotten a 1.25 follow through day. Because I mean, we were making moves of 2% a day or more. But one of the things that you have to be careful of is if you make that threshold too high based on the volatility, and 2009 is a good example. You don't want to necessarily say, oh, you have to be X factor times the volatility, because then you could just, oh, you have to have a 7% follow through day in order for it to count, if you kind of go that way. But you know what? Someone asking about the subsequent follow through day. Why don't we just? I looked in my database and I can go ahead and share an example here that we had with this recent COVID crash. So we had our follow through day for the NASDAQ. That was right here on the 6th. So April 6th was the follow through day on the NASDAQ. Now, if you fast forward to the 14th, that's a subsequent follow through day right there. The 16th, a subsequent follow through day right there. The 17th, a subsequent follow through day. Does that meet your definition of a powerful rally? 3 subsequent follow through days very shortly after.
Exactly. That's exactly what I'm talking about.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.